Welcome back to another episode of the Educated Homebuyer Live with Josh and myself. This is where we answer your questions about mortgage, about real estate to help you become the educated homebuyer. So the big news, the good news is that I was wrong last week on Wednesday when we talked about the 10-year chart. Fortunately,
Were you?
well, not entirely, but you can tell that side of it in a minute. But fortunately, the jobs numbers actually came in better than expected on Friday, and we've actually seen a retracement a bit in the 10-year, which has allowed interest rates to come down a little bit. But Josh, why do you say has it? Why are we having that conversation?
Well, when we get to the chart on the 10, we're going to show you because we are still, and you will see it in the chart very clearly, we are still in an uptrend. So you may see in the news, you see rates make a 3-week low, rates lowest in 6 weeks. Tomorrow, Thursday, we get Freddie Mac's primary mortgage market survey, which they would have surveyed lenders on Monday. So it's already out of date, but one of the better days of the week pricing wise. So everyone's going, hey, rates are great. They turned the corner finally.
They're not going to say that. They're not going to say rates are great.
They're going to say rates are better. It's turned a corner. It's improving. And the reality is we are still in an uptrend until we break the bottom of that channel. And if we do not break the bottom of that channel, Jeb very well may be right that the next move is to the top of the channel, which will be beyond the 465 that we were a week or two ago. And the next stop is 5% and close to 8% mortgages. So it visually in the chart, it's easier to see, but we have learned nothing yet except for crisis averted for now.
Yes, and we're basically just waiting on more data, right? So CPI comes out next week, which is really the next market mover in
next
the market.
Wednesday, before we get together again here.
Yes, absolutely. So we'll see what happens there. It's a 0.4, I think, that's coming off based on the last 2 months of 0.4. Looks like we're probably, if we're consistent, CPI will stay the same. We won't see an improvement, but we will see, right? I mean, we've been surprised with a couple of the numbers. We will see going forward what that looks like. But for now, what we're going to do is take some time and actually dive into the charts that we do every single week to help you guys become, again, educated home buyers. And as we always start, Josh, we start with inventory. Inventory only ticked up about 0.5% this week. We saw 3,000 new active listings come to the market. Now, this is coming off of 2 weeks of about 16,000 listings. So, 1 week doesn't tell the story, right? We need multiple consistent weeks of doing the same thing to tell us whether or not inventory is topping out or not. It'll be interesting to see what actually happens here, but we only added about 3,000 homes, which you'll see here in just a minute. Orange County, we're sitting at 2410, Huntington Beach at 142. Now we're going to look at the charts for Huntington Beach and Orange County here in just a minute, but I put this in there just to show you what active inventory looked like for the first week of, or the first piece, if you will, of April. This comes from calculated risk. Sometimes he has a laundry list of markets. Other times he boils it down to just a couple of markets. It's just based off when the data actually comes to him. So as you can see at the moment, if you look at these cities, year over year, inventory is up pretty much every location. Las Vegas pretty much flat. But when compared to 2019, you're more or less down considerably, unless you're looking at Denver, which is more or less flat. So, again, inventory nationwide is growing, but it's really concentrated in a couple of markets like we discussed last week. Now, this is looking at Huntington Beach and Orange County, just kind of our charts going back to the beginning of 2023. So we're about 17 or so months into what these charts look like. And you can kind of see, we started up, we went down, went up, went down, kind of riding back up, if you will. And this is about the time of the year where last year, the year before, this is when we would have peaked. Last year, we didn't peak until November. Normally, this is about the time of the year when we kind of see the peak in inventory. But because of rates staying high, it's going to be interesting. I think you'll continue to see inventory grow, kind of like we mentioned last week. This one just kind of shows that week over week change that we mentioned, went from 556, 291 to 559, 744. we're almost to the peak that we saw last year, Josh, that happened in that November-ish timeframe at 569. So we need about 10,000 more active listings on the market to reach that. My guess is we're going to surpass the level seen in 2023. I'm about to sneeze, so I'm kind of trying to figure it all out over here. I'm waiting for it to come out. Nothing more frustrating than getting ready to sneeze and then not being able to. Sneezing is real. There's something about it. Just it feels good unless you do it multiple times in a row. Anyway, stuffy. I'm coming from the soccer field again, Josh. This happened a couple of weeks ago. But
stop going to the soccer field. Tell the kids they have to play on the indoor, the fake grass.
So new listings. So new listings this week, 71,000 new listings unsold this week, slightly fewer than last week, but still generally rising. On top of that, we had another 22,000 new listings already in contract, essentially immediate sales. Came to the market immediately under contract, so they don't get added into that listing inventory. This shows new listings coming to the market in those same cities that we were looking at earlier. Year over year, again, more new listings coming to the market for this time of the year. But compared to 2019, all of those markets are still down at least, for the most part, 20%. If we're averaging, probably closer to 25%. San Diego being the one that is down the furthest, down almost 40% from 2019. Total home sales contracts pending. So let's see here. 393,000 single-family homes in contract right now. That's 3% more than last year. Not a lot of growth, but it is a little bit there. New contracts pending this week topped 78,000. That's up 1.4% for the week and 11% more than the same week last year. That takes us into median price of homes on the market. Median price of homes in contract, $399,999. So $1 short of 400,000. This measure of home prices is 5% higher than just a year ago. Median price of all homes on the market is sitting at $449,990. This is basically unchanged from a year ago. And then the biggest difference we're seeing is percent of properties with price reductions actually jumped quite a bit, now sitting at 33.5%. Last week, I think we were in low 32s, jumped over a full percent of homes taking some sort of price cut. So,
Jeb,
probably going to see more of that as, you want to go back?
Well, go back to that one because I wanted to ask you your thoughts on this. When I look at that, I go, okay, what have we seen? We've talked about over the last couple of weeks that the Gulf Coast states are where we're seeing these bigger increases in inventory, and it's making it look like we're seeing inventory around the country. Well, Florida is the biggest area. The southwest coast of Florida is the area that's seeing the most of these price cuts. It would be very interesting to see how concentrated those are in the Gulf Coast and Southwest Florida specifically, because I'm going to bet, and I'm a little bit biased because we talked to a lot of people here in Southern California along the West Coast, where we either have a very hot market in Southern California, but the first-time buyer markets, even in Washington, Oregon, Northern California, those are the prices under $1 million, which sounds crazy to call those the more affordable segments of the market, but those price points are still relatively hot. So we see not price cuts, we're seeing multiple offers. It's been a long time since I have had a buyer just roll in and write an offer. I have one in Texas right now in a market that is not seeing that rapid appreciation, that has more inventory, and they went in 15,000, which was like 10% under. It's a $165,000 condo. They offered 150 today. So it'll be interesting to see how that shakes out. But I look at that, and the other thing about that chart that's interesting to me, you look at 2022 was the big uptrend because we hit April and the rates skyrocketed. So that line, I almost throw that one out. But if you look at all of the others, they follow a similar shape. It's kind of surprising to me, and I'm sure if I thought about it more, there's some logic to it, but seasonality of price cuts on homes, that's interesting.
Yeah, no, agreed. I think it's just there's more homes on the market during that time, and people are needing that transition maybe before summer, before vacations, before the new school year, and they got to do what they got to do. It's hard to say. But nevertheless, you mentioned homes on the market being under $1 million. I saw a stat today from a newsletter, not a newsletter, but an email that we both get. That's Orange County, roughly 2,400 homes on the market, as you saw that I mentioned earlier. 70% of those homes are over $1 million. 70% of the 2,400 are over $1 million, and 35% are actually over $2 million bucks. Crazy. 35% of that 2,400. So that's what, 700 plus homes, 800 homes, 800 homes, over 800 of those properties are over $2 million bucks, which means they're not even available for the general public for the most part, right? That can actually afford them.
And think about the title of tonight's show. The housing market is divided. If you're trying to find a home under $1 million bucks, you're like, this market is crazy in most places.
Mm-hmm.
And that number in your market could be 700,000. It could be 400,000. I guarantee you every market has that sort of line of demarcation of where are entry level buyers trying to get in. And that market is tough. And above that, much more balanced. It would, I'm sure if you're here in Orange County, you want a $3 million house, you're not having the struggles that someone wanting an $800,000 house is having.
No, and actually, I'm glad you brought that up. So when we look at the title tonight and the thumbnail of tonight's video, the housing market's divided. That minus 82% is what inventory looks like in, I think, Hanford, Connecticut, like some town in Connecticut. I forget where it is. Inventory's down 82% from the norm, not from last year. 82%, whereas other markets are up 30%. 33%. So just shows you've got two different markets. The Northeast, still absolutely crazy. The Southeast, less crazy. The South, less crazy, right? More and more inventory coming to the market, which is creating that divide, if you will, depending on where you're located. So Josh, what are we looking at here?
Lots of info there, but just look at the green box. It's Goldman Sachs' most recent forecast. They are saying 4.3% for 2024, 3.2% for 2025. And I look at that and I go, please, soon, fast, let's get to those numbers. Just because we saw the numbers coming out.
4.3%, what? 10-year? Or I mean, like, so the person listening on audio knows what we're talking about.
Home prices. They're forecasting home prices 4.3% appreciation in 24, 3.2% in 2025. So that's what they're expecting for appreciation. And yes, we would love to have that for the 10-year, but I think more so for appreciation. We need this market to flatten as much as possible. And it kind of goes back to the limited supply and the entry-level buyer market. Who cares what happens for people buying $2.5, $3.5, $4 million homes? If you're fortunate enough to be one of those people, I really don't care what happens in the market. Let's get you whatever is the best possible, but it is what it is. For entry-level buyers, we need an extended period of 0 to 3% appreciation, not even 4 and 3. And where I was going with that is, Jeb, we saw last week, Case-Shiller, FHFA, they all come out projecting, showing year over year about 6% gains. That's too much. It is too much. It's too much for 1 year, much less coming on the back of the appreciation that we've seen. We want the market to cool. And when it does, people are going to freak out. Oh my God, we only got 2% appreciation. Well, historical's 4, and we had several years of outperformance. We should expect several years of underperformance, and that will be good and healthy for the market in terms of restoring affordability, along with hopefully interest rates moderating and wages continuing to increase. And we'll go through the wages here because that was the big one. Jeb, before we do that, you guys probably saw that big headline today. Pretty much every financial news media outlet came up with it. The Federal Reserve Board, I think it's the San Francisco Federal Reserve Board, is the one that's been tracking this cumulative pandemic era excess savings. So at the peak in August of 2021, U.S. consumers had $2.1 trillion more in savings than what they otherwise would have had with the trajectory of savings for the 48 months prior to COVID. And looking at this, that is now all gone. Jeb had mentioned probably 7 or 8 months ago that it was projected to run out somewhere in the fourth quarter of 2023.
I think it was September.
So apparently spending slowed, not enough, because the economy has been surprisingly resilient, surprisingly strong. Well, you're looking at this. There is a wall at some point. We've shown the consumer debt increasing. We know credit card debt is at high levels, even if debt service isn't at high levels. So eventually this does trickle into the data. This is just another chart here showing the personal savings rate. We are flat and trending down actually, but flat over the last 2 years and below the pre-pandemic era. We were at about 5% for the 5 or 6 years or prior to the pandemic, and we're at 3.2% with a little bit of an inflection point downwards. So something worth watching for those that say, nope, the economy is resilient, strong, and it's going to be amazing. We're in an interesting spot here, Jeb, that we want affordability to improve. The easiest lever to pull to do that is lower interest rates, and lower interest rates requires a softening economy. But by definition, that softening economy is not good for households. You're having job losses, things of that sort. So it'll be interesting to watch. Malden threw this one out this morning, Jeb, and this is kind of what I've been pointing at. Every month, we had last Friday, we had the jobs report. It came out at 175. I don't remember, Jeb, was it projected to be 224 or 240? Somewhere in that range, and it came in at 175. Oh, it's a soft jobs report. But if you look at this, going back to January of 2023, it's been in a really narrow range and relatively flat. So this is not a weak jobs market. It's not a strong jobs market. We went through that in the charts last week of just showing people aren't quitting jobs because they're worried about getting a new job. Employers aren't firing anyone because they don't want to go find new good employees, but they're also not hiring. We're not seeing job postings. Job openings are decreasing. So it is kind of a middle of the road market. It's not enough to cause the Fed to say, hey, problem solved, crisis averted, we can lower rates, but it will be worth watching to see when and if something gives there. This chart looks at it a slightly different way. The unemployment rate ticked up last week to 3.9%. Average hourly earnings are increasing still, but just at a lower rate than what
Unless
they
you
were.
live in California, it jumped like 25%.
Jeb, I went and got a baked potato with 2 chicken breasts on it last night. It was $22. I'm like, what are we talking about?
Bro, first off, that's the oddest meal you could order from anywhere.
Oh, it's Moe's potato from Charo Chicken. It's delicious. A little garlic butter, lemon garlic butter on it. It's delicious. Very good dinner.
All right.
How do you not know about a Moe's potato? I can't
don't go to Charo's Chicken. I don't like it.
Oh,
I'm not a fan. Not a fan.
You're crazy. For those of you not in Southern California, Charo Chicken is El Pollo Loco, but good. So Jeb, here is our chart. For those of you who are watching on YouTube versus listening, this will be an easy one to see. Those 2 red lines are that uptrend. This is the 10-year. The yield is clearly in a defined uptrend since the beginning of the year. So we had talked about that top green line is about 465 on the 10-year. And it held. And then thanks to the soft data on jobs last week, we've improved down to about 4.5 right now. We can go all the way down to about 441 and still be in that up channel. So we need to see a sustained break below the bottom of that channel before anything changes. Because if the bottom of the channel holds and 10-year yields start rising again, most likely it will go to the top. Again, for those of you that are looking, watch what happens. When we stay in that trend, it goes to the top of the channel and then it corrects and goes down, which the yield on the bottom of the channel is higher than the last low. So it's still trending up. And again, it makes a new run to a newer high and then a higher low, a new higher high. So we are hoping that Jeb is wrong, but as of yet, he is not wrong.
I'm hoping I'm wrong
until we break out of that channel. I think he would happily be wrong on this one. This one, I just kind of wanted to show you again, for those of you watching, this is what's happened since the 4th quarter of last year. Run up to interest rates where we peaked near 8%, run down well under 7%, another run back up. And we are hoping this little right side of the chart, that little green arrow, rates continue moving down. Jeb, this one I like. This is interest rates going back to the year 1310. So what does that give us? We're 2024. Are you good with math? That's 690 years plus 24. So 700 years of decreasing interest rates. So while our 40-year downtrend in interest rates has broken, the bigger macro channel of 700 years of lowering interest rates is still in place. So when I have those conversations with people and they say, well, we're never going to see interest rates at 3% or 2.5% or 2% again, I point them to this chart, Jeb. So I thought for perspective, it was good for everyone to have. But a shorter term time frame, as of this week, Mortgage Dues Daily is reporting 7.2. I think last week we were at 7.4. FHA at 6.64 or so. Oh. You made the stuff disappear.
I did. Poof. How you like that? And now I can't. There we go. Good stuff, guys. So, I'm going to mention our podcast that we put out this past week. Basically, just talking about the housing market, talking about Josh's perspective, talking about my perspective, what we're seeing out there, talking to clients, talking to consumers, potential clients. It's an interesting conversation, seeing some things that we haven't seen before. If you haven't listened to it, go check it out. It is here on YouTube at The Educated Home Buyer. And while you're there, if you're not subscribed, please do so. Consider doing that. It supports the channel, supports our work. And if you're a podcast listener, you can check it out there. And also, if you like to listen to just the audio, you don't like to look at Josh and I's face, this actual episode goes on the podcast channel every Friday. So you can listen to it there if you want to, just dial the information into your skull and just listen to it over and over again. You can do that. Now, one thing I am going to talk about here today, Josh, is that we often get people asking us about rate locking. Should I lock my rate? Oh, how do I lock it? What happens when my rate lock expires? Can I, whatever questions, every question about rate locking. Well, today, good news is we recorded an episode, about 40 minutes of talking about rate locks. Is that dropping next week, Josh, or is that the following week? When are we dropping that?
The tentative plan is 2 weeks from Tuesday, and we will have our friend Ed Pinto, just a very long conversation with Ed that we need to edit down a little bit for consumability. And I have been putting off that arduous editing process, but I think we're going to go with that next Tuesday. So either 2 weeks from Tuesday, or if that edit proves too cumbersome, maybe you get it next Tuesday.
Fair enough. All right. So what we're going to do now is we're going to answer some of your questions. But before we do, we got Mina giving us a $5 super chat saying, is there a minimum amount percentage you have to put down to recast a mortgage loan? So Josh, that's going to go to you. So is there, maybe just mention what a recast is briefly. And then is there a minimal amount?
So a recast is if you have a better interest rate than the current market, so making or doing a refinance doesn't make sense, and you want to make a large principal reduction, you basically go to your lender servicer and ask them, hey, I reduced my balance. Can you do essentially a modification to adjust the monthly payment to pay off the remaining balance over the remaining term of the loan? The important thing here to remember with some loan types, it cannot be done. It's not allowed with FHA and VA loan types. So if you have a conventional loan, you are asking the servicer to do something for you. They don't have to at all. So my answer to this would be they probably do have a minimum amount. They're not going to do it for $2,000 or $5,000. It's going to adjust that payment like $30. So reach out to your servicer and find out if you don't yet have a loan. I mean, I don't remember if you've already bought or you're looking to buy here in the near future. But I would say there probably is a minimum threshold before they would be willing to do it for you.
All right. Jonathan asked, should I lock my rate? He said, should I look my rate? But I think he meant lock before the May Fed meeting. So Jonathan should probably listen to that episode, Josh. So Tuesday, if you put it out Tuesday, it's going to drop before the next Fed meeting. Actually, it'll be before CPI. The Fed meeting has already happened. We're past the May. We're past the May.
Because it across the 2 days was the last day of April and the first day of May. So we don't get another meeting till June.
Yeah.
So CPI, as Jeb said, is the big market mover here in the near term future. And then after that, we really are going to next month's jobs report. And then shortly after that, the Fed meeting.
So by the time the next Fed meeting comes out, that episode will be out. But by CPI, it may or may not be out. So, talk to your mortgage professional, see what they say to you. As always, if you want to get in touch with myself, you want to get in touch with our team here to, have Josh look over your mortgage, whether you're in Southern California, wherever you are in the nation, that referral link there at the bottom will get you in touch with us. And if you're looking to purchase a home, need a real estate agent, I can be part of that process. You can also use that referral link and we help guide you in the right direction. All right, Josh, there was another question.
Let's go back. Let's go back to the chart in terms of answering his question real quick. Which one do I need here? I need this one. Yeah. This channel. So what I would say, Jonathan, is you want to be watching this. That 441 level is really
How does important. He watch that?
So any financial news outlet, plug in 10-year treasury into Google, and it will show you a lovely chart of the 10-year treasury. Because if we break out, then you want to let it go. You want to float. You do not want to lock, but you want to get really cautious when we get near the bottom of this channel, because as you can see, when it turns, it doesn't go back up in 2-3 days to the top of the channel. The last time here, it looks like it took us a week or two to get up there. So it's not like 4-alarm fire, I got to go ahead and lock. But if you see us bouncing off the bottom of the channel and rates trending back up, you probably want to lock it because it's going to run up to the top of that channel. If it breaks out of the bottom, you just watch and let it go, because we would be looking for where the new range is at.
All right, good stuff. Drew has a question here and says, good evening, gentlemen. I know this is a housing market show and I love it. Thank you. Thank you. But have you heard about what is happening in the car market? Ripple effect, cars first? No, I don't think so. Car market is entirely different on a number of levels.
The most important one, Jeb, is just simple supply and demand. What's
right.
preventing the supply line from opening up and making more cars?
Well, let's talk about what happened. What created that backlog in supply? Well, the pandemic did. It was a shortage of being able to get parts, to be able to get chips to actually produce these cars. On top of these assembly lines weren't allowing workers to come in because they couldn't be in close proximity to one another because of COVID and people being sick. So you got this huge backlog, and rates went down. And guess what? Cars were less expensive on a monthly basis. It became way more affordable. People wanted cars, so on and so forth. Similar to housing in that regard. But like Josh said, nothing now is preventing car manufacturers from making more cars. What's happening is some of the car manufacturers are still not producing enough cars to keep up that demand. I mean, if you look at some of these trucks, Josh, you want the TRD Pro. That car is very hard to get. It is not something you can just walk on a lot and buy without paying a premium on that car. Whereas other cars are having, markdowns and different things because they produce so many of them. Tesla, for example. Tesla, I bought my car, in 2022, Josh? And it's worth 2/3 less in value than I paid for it 2 years ago, which you expect it to decline, but not at the rate that it declined, because just he's dropping prices on cars in order to sell them. So to get back to what you're saying, no, I don't think it's the same thing at all. On top of that, people don't have to have a car. I mean, you need a car.
You don't have to have a new, latest and greatest,
Exactly.
top of the line, expensive car.
And you could say that about a house, but you just need a house, right? You don't have to have the new construction house, but you have to have a house. So it's different in a lot of ways. My expectation, based on what I've read and people that I follow, is that the car market's probably going to continue to get worse. You haven't seen the worst of what's coming in the car market quite yet, but that's just my 2 cents.
Let me say the same thing Jeb said in a different way. So we had an artificial constraint of supply for vehicles, and the manufacturers really enjoyed this because it pushed prices to the moon. Not just the manufacturers are selling them to the dealers for a fixed price. And then those dealers go, hey, we don't have enough of these. We can charge extra on top of that. That's pure profit in our pockets. And it's like crack. They got addicted to the crack. So now that artificial supply constraint is gone, and they're realizing consumers don't want to pay extra, can't afford to pay extra. There are some additional costs to the manufacturers in terms of what we had. All of the auto manufacturers, all of the United Auto Workers threatened to strike last year. So they get paid more. Natural materials, chips, all of those costs have gone up, but not nearly equally to the price. Jeb, I told you last week, they just released pricing for the unreleased as of yet new Tacoma TRD Pro. The one that you could have bought last year was $50,000. The one that's coming out next year is $65,000. There's no cost of labor and materials that justifies that. They looked at this, Toyota looked at this and said, hey, why are we letting dealers tack an extra 10 grand on there? Let's do it from our end and tack an extra 10 grand on there. So something has to adjust. With housing, we're going to go into this in that episode that's going to release next week with Ed Pinto, that there is it is technically an artificial supply constraint in terms of zoning guidelines, regulations, and changing that and turning that ship around is a long timeline. So will we see something similar in housing? No, because you can't just turn the spigot of supply back on like you can and have to in autos, because the only way that manufacturers can make more money is manufacturing and selling more autos. They can't go, hey, we need to keep our margins up, let's constrain supply.
Yeah. And the last thing I'll add to that is I was actually, it's funny, an hour ago talking to a buddy of mine who got a Ford Raptor, I don't know, 6 months ago, less than 6 months ago, maybe 4 months ago. And we were talking about the price, and he said, that I couldn't find a dealer out there that didn't tack a premium on it. Even today, like couldn't find one that didn't tack a premium on. And I believe what he told me is the price was somewhere around 80. Ended up buying it. He got it for 84 because the cheapest margin he could find, the best margin he was able to get is somebody charging him 4,000 above MSRP. So he paid 84. By the time he was all said done with taxes and everything, he was out at like 96. And then he said he got the extended warranty to 100,000 miles, which was another $4,000. So he ended up paying $100,000 for a Raptor. And it's like, that's 20% more. Granted, there were some couple things in there that didn't necessarily have to be paid, but 20% more than 25% more, if you look at it that way, than the car was actually, initially priced. So, anyway, long story. We could go on in more detail about it, but
Jeb, there's a famous saying about inflation is the cure for higher prices is higher prices. Anyone who has something is going to push the price as high as they can until eventually the buyer goes, piss on this.
I'm not doing that. Right. No, exactly.
And then the price comes back down.
We got 2 super chats from Pranoy, one for $4.99, one for $1.99. So we got $6.98 that's been contributed. And for that,
I appreciate that.
We are grateful. So thank you. But follows up with a question. I'm under contract for a house and the value is now more than our purchase price. Can the equity gain be counted towards the LTV, therefore getting rid of PMI when closing is the key question here, Josh?
This might be one of our most popular questions. Would you say every 3 weeks we get this one, Jeb?
Something similar, yeah.
Pranoy could have saved his 698 by just going back to past episodes. We probably answered it 14 times. It's important to note that your loan to value is determined by the lesser of the purchase price or the appraised value. So if your house appraises for $32 billion, it does not matter. At purchase, it is going to be determined by the sale price. Now, it used to be most loan programs after 6 months, you could use the appraised value. You can use it after 6 months to get rid of mortgage insurance. You have to wait 12 months to be able to use the new appraised value to do cash out if it went to $32 billion and you wanted to borrow $1 billion or $2 billion.
Good stuff. Burn It Up is late, running on only 3 hours of sleep, but here to support. So thank you for that. Elva made it to alive. Thank you for being here, Elva. There was a couple of others here. We've got Willing in here. We've got Kevin in here. A lot of our regulars here. Big G just stopped in. He only buys Toyota Camrys. We did say that was a guy, right? Or did we determine?
Yeah, I don't remember.
Big G. Well, I don't remember either. We're just going to go with they. We're going to, your pronoun is they.
They are here.
Until we determine your pronoun. We're going to use that. My God, why are we using pronouns?
The funny part, Jeb, is the last time that word came up, we had someone who was triggered in the comments and had to unsubscribe because we were being cavalier about the use of pronouns.
Oof, probably not the right place for them. Smart Fox, how do you know if an area is depreciating specifically in Southern California? What should you look for in an area? Or do you always look for how good job industry are that they are moving in? No. How do you know if values are depreciating? You would look at what comparable sales are selling for is how I would determine whether values are depreciating. When it comes to jobs and that sort of thing, like you can look at job growth, you can look at, industries that are coming and or leaving an area that may have some sort of future impact on values, but it's not going to happen immediately. Let's kind of take it the other way, right? So let's take a market like Inglewood. Inglewood saw huge appreciation in a short period of time. Why? Well, because they saw that the LA Rams and the San Diego, or not the San Diego Chargers, what are they? What's the Los Angeles
Los
Chargers?
Angeles Chargers.
I was
Let's
going to
talk
say the
about the
Orange
most
County
important
Chargers
part, Jeff. Let's talk
were
about the
coming
most
there. And
important,
then the Clippers, right? So
the
all of
most
these
important
teams
part.
coming there, building huge arenas, adding value, if you were, to these areas. That, on top of being close to LA and not having to deal with some of that traffic, I mean, those are all benefits to that community. And so you saw a huge increase in value. Rarely ever do you see values go the other way that significantly without some major change, something catastrophic happening. And if you want to mention the city that you're talking about, we can actually talk a little bit more specifically, versus
And Jeb,
just saying
I
SoCal.
think CAR publishes the data all the way down to the zip code level. They're publishing median sales price. They might throw an average in there also. So you got to look at the data and know what you're looking at. But you can go all the way down to a zip code and look at what's happening month over month, year over year. Southern California, it's a big area that includes Imperial County, which, like, there's no one out there. It's dirt and rocks. So it's a big area. You got to talk about what are we talking about? The difference between, Malibu, which is unlikely to depreciate anytime soon, or Hemet. We have another question here. Big G wants to know something about Hemet. We can go through that. So Southern California is a big
Imperial
area.
Valley?
No, Hemet, I think, is Riverside County, if I remember correctly.
Know. Yeah, I probably sound like an idiot for asking that, but I truly don't know what county it's in. But this is a really good question. So Rosangela says, I live in a condo in Florida, and condos are not selling at all, but also they are not renting. Why? So let's talk about the let's talk about the selling aspect. It's not that they're not selling at all. Where you're located, they're not selling. And a primary reason that you're seeing a lot of condos sit at the moment is because of insurance, because of HOAs. A lot of HOAs can't even get insurance policies to start with because of cost rising, because of insurance companies not wanting to insure. All of that's factoring into the HOA dues, which are doubling, quadrupling, whatever they are in some of these cases. And it just doesn't, it's no longer, the affordability piece on rates is one thing, but once you start tacking on insurance doubling, tripling, whole different deal. And people just don't want to deal with it. So that's really the biggest reason that you're seeing condos not selling, at least in my opinion. I'm not in Florida, but that's based on what I'm reading. That's why.
Florida,
So Josh,
Jeb, is very interesting because, there's condos everywhere, but the density of them in Florida, there are so many more of them, and they were the bleeding edge probably back in the 50s and 60s of building condos. So many of these are old, deferred maintenance, not built to current building codes, whether that's hurricane codes. In California, we would say earthquake codes. So we had a listener, Jeb, reach out, 2 weeks ago, said, hey, I'm in escrow and this doesn't meet the Fannie Mae guidelines because the master insurance doesn't cover what they needed to cover, and they cannot get insurance coverage to cover what Fannie requires it to cover because of the codes under when they built it. So that's really the interesting part of where that's going. It is much harder to finance them. So you have the normal supply and demand issues, but sort of that accelerant or brake on the demand there in terms of the availability of financing. It's much more difficult because Fannie and Freddie have gotten much stricter on the financing. So many of these communities where people would be happy to live, they can't get financing that they would be happy to pay on every month.
Good stuff. Just to follow up real quick on this one before we dive into a question, Joko says, seems like the Sarasota, Florida market has not had too many price drops. Why is that? We don't know Florida well enough to be able to comment on it. If you're not seeing price drops, it means that there's more demand than there is inventory. That would be my guess, but I can't speak to it specifically because we're here in Southern California. La Quona, we did this one last time and I messed it up.
I'm going with La Quona.
I think that was right. I purchased my home with a VA loan. Can I refinance with no documents? So first off, I want to say thank you for your service. But Josh, how does VA work when it comes to refinancing?
So VA has something called an interest rate reduction refinance loan. It does not require an appraisal, does not require income documentation. So the important thing to remember with this stuff. So the short answer is yes. Does VA allow it? The bigger answer, or the longer term answer, is that lenders put overlays. When we were coming out of the downturn in 2008, when some of these were significantly underwater, there were some lenders that said, we want an appraisal, or we want an automated appraisal, an AVM, just to confirm that we're not lending on something that's significantly underwater, despite the fact that the government is insuring that loan for us against future loss. So right now, we don't have nearly as many of those overlays. When I go in and look through the guidelines, I don't really see a lot of them. So most lenders are going to allow you to do a refinance with no documentation, including an appraisal, which is the two things that are important. You don't have to document your income. You don't have to document your employment. You don't have to show, so that was one of the big overlays. Many lenders say, I just want to see that you have a job. VA says, I don't need a job. We're already on the hook for guaranteeing this loan. If you make the payment now, that is the greatest predictor of you being able to make the payment on a lower monthly payment. So they will allow you to do that.
Good stuff. Here's a question that's not related to anything, which typically is what happens when Willing makes a comment, but it is something I'm going to speak to just because I just read something weird on one of my friends' Facebook pages. Willing says, I sprayed for fleas last night. Will Gwen be okay? Gwen is Willing's dog that I think we helped name here a couple months ago. I'm not sure we went with Gwen. I think it sounds like you kind of made that up. I think we went with something more ferocious, but we'll go with Gwen. But here's the reason I'm bringing this up. I saw a friend had posted something on her Facebook page the other day that she sprayed her dog for fleas with one of the major brands out there. It was like it started with a P. I forget what brand it was. And the dog started having seizures and something else. And she was like, is this like normal? And I tell you, there must have been 20 people that I knew on that comment thread that said they had a similar experience. So, hey, I don't know. I don't have pets at the moment, but if you're spraying for fleas, just be careful. Make sure you read the back of the box, because it sounds like might send your dog into to potential seizure activity there, and there's no way to really get it out without them throwing up and other things. So anyway, Josh, that's my help. That's kind of like my Bob Barker, have your pet spayed or neutered. Just, if you have a pet,
careful with the flea spray.
Careful with the flea spray. There you go. The flight simulation experience. Would you guys rather be buyers at 14% in interest in 1999 market, or a buyer today with a 4% rate at today's prices? Please make the case for the constant boomer argument about these rates are nothing. So I'd rather be back in 1999 at 14%, just because the house price was like a tenth of what it is right now.
My house was about $300,000 in 1999. So 1/6 of what it is today.
Yeah. So, I mean, that's the better argument, right? But the question, make the case for the constant boomer argument about these rates are nothing. Yeah. Most boomers say, today's rates are nothing because I had 14% when I bought my house. Who cares what somebody had before you, right? Doesn't matter. You only care what affects you. And that's really what you should care about. It's how does it personally affect you? And what I will say is, too many people at the moment are too worried about things that affect other people versus actually controlling what impacts them personally. So, I'm going to just kind of vary from your question here a moment and go, just worry about yourself. Worry about what you're comfortable with. Don't worry about what somebody did in 1999 or 1980 or what they paid, because guess what? It doesn't matter. You can't go back there. You can't deal with it. Focus on what you can control.
Not only, Jeb, can you not go back? We look at it with what we know about the last 40 years.
You didn't know anything back then. Yeah.
Who knows? If you're in 1982, those boomers were scared shitless. They're like, what in the world happened? Rates went from 7%, 5% in the early 70s to 10 years later, 17%. And they're looking back. Guess what? Gen Z, and what are the ones after that, Jeb? Gen Z, the one we got millennials and then Gen Z. So be real careful when you're saying, oh, easy, you had it easy. When they're doing that in 82, they didn't know what was coming next. They were scared too. You don't know what's coming next. Anything could happen. Could be worse, but it could be a lot better. So to look back and say, oh, you had it easy, someone buying in 1980, 81, 82 was scared to death, and rightfully so. No one knew that we were going to have the big 40-year bull run in interest rates, and that was going to cause asset prices to go up, and it was the greatest tailwind anyone could ever have. Is it likely to recur? It is not. But again, you can't change it, and none of us have a time machine. So let's stop worrying about it and stop downplaying someone else's experience. Those people also likely had to go to Vietnam. Do you want to sign up for that one? You like how I threw that
Well,
one
I don't
there,
think
Jeb?
they were, you kind of like you took it out on them there. I don't think they were like arguing about it. They were just kind of saying, hey,
No,
what are
no,
your
no. But
thoughts? Yeah.
most of the people that like I saw an argument the other day, and it's like my wife brought this to me. She goes, "Is this person serious?" And this guy's mind was boggled because he had read an article. This is like a 24-year-old. He had read an article that boomers are going to transfer $70 trillion of net worth to younger generations. And that blew his mind. Like, how? That's so unfair. How did they get this? He said, hey, dummy, they got it through 50 years of living. In 50 years of earning, saving, investing, and inflation, you will be part of the generation that is the richest generation. It's not like this was some golden selected generation. That's how it happens. Gen Xers are going to inherit a bunch of that. They're going to hand it down to millennials. Millennials are going to hand it down to Gen Z. And someday Gen Z is going to be the old people that have all of the money that some clown on TikTok is going to go, this is
And
insane.
TikTok's not going to be around, dude. TikTok might,
They have
they might not
300
be around
trillion
in
of net
30
worth.
days.
But it's just ignorance of how it works. Time, saving, and inflation makes that happen. And the oldest generation is always going to be the wealthiest.
Good job. Good stuff. Colorado, Brett, who said excess savings are gone, Josh? We've had 3 different people tonight with super chats.
This is where it's
excess
going.
savings,
It's going to super chats. It's all the
good.
excess savings is
So,
coming to our account.
Colorado Brad, $10. Thank you, Brad. Says great insights and market coverage as always. Appreciate you being here. Appreciate the support.
Colorado Brad, we need to know your co-pilot's name there.
Well, let's see here. Colorado Brad might have just gave us money and bailed. We'll find out.
Gave money. I got my analysis. I saw the charts. I'm out.
Yeah. Marcus says, what is your experience with renovation loans and what happens if the house needs more work than you can afford? So Josh, a couple type of renovation loans where you can buy the home subject to improvements, if you will. So you can actually finance those improvements into the loan. FHA 203K is one, and then you got home ready, right? That's the second one, which allows those improvements to be financed. I'll kind of give a brief explanation. You can add on to it, but essentially what you do is you go in, you buy the home at the present value, you have contractors come in, bid what it's going to cost to do those improvements. You have an appraisal with the current value and then an after repaired value. And then the lender essentially will, if the deal makes sense, give you the money to do the improvements that were part of that renovation loan. So Josh, what happens if and when there's change orders or something gets more expensive in that process?
This is why we tell people it is critically important to be careful when you're doing a construction loan or a renovation loan. Both of those programs require consultants to step in and review the plans. They also require you to have contingency reserves. So there are safeguards in place, but that is no guarantee. It's also why many or most of them won't allow you to do the work yourself, because they're not going to trust that you will get it done on budget, on time, or that, hey, this is $60,000 worth of work, but I'm going to do it myself so I can get it done for $20,000. There are safeguards built into it. But with that, I'm sure there have been issues and problems. That's why those loans have higher interest rates. That's why there is a consultant at the lender that's overseeing this and checking in that if you go silent for 2 months, they're not just going to go, hey, well, someday we'll get that thing done. They're going to come out and go, hey, what's going on? And if they have to, they'll bring a contractor in to finish that so that they actually have good collateral for the loan. So you're right that there is additional risk there, but there are safeguards in place.
All right. Burn It Up has a question, says Cypress or Buena Park, which would you choose if given the choice and why? So those are both cities here in Orange County. I would personally say both have nice houses in both locations. Both have great neighborhoods in both.
They are adjacent, right, Jeb?
They're right. Touch? Yeah, they're touching each other. I would say Cypress personally. Cypress is a little bit closer to the beach. I'm more of a beach person, and and the closer of the cities would be Cypress, based on the way that I look at it. So for that reason, Cypress would be my choice. But I think you can't go wrong with either, assuming you're buying in the right pockets in those neighborhoods. So just my 2 cents. Let's see. Josh, Big G says the feds have put new regulations on air conditioners, thereby raising the cost in them to about $12,000 to $13,000. Do you think this will have an impact on home prices and or home inspections? No, I don't. Will it have an impact on buyers putting new air conditionings in and or replacing old air conditionings? Potentially. But I don't know that it will have an impact on pricing home prices at all. In fact, you'd be really surprised. Many people would be surprised listening to this, that I would say 60%, Josh, and this is a mere guess, just complete guess. 60% or so of the homes here in Huntington Beach don't have air conditioning. It's probably higher than 60%.
Yeah, it's probably like 70 or 80% do not
have air conditioning. So I have air conditioning. Josh has air conditioning. People that say
I talked you into getting it. Once you have it, you don't go back.
You never go back. It's a must. But anybody that tells you don't need it, they're crazy. But anyway, that's we'll move along. We'll move along from that.
Jeb, we have a very, very critical answer. Colorado Brad followed up with the important information that is Brad Jr., better known as BJ.
BJ. You can't go by BJ. We'll call you Brad Jr. Brad Jr. is better. We're going to call you Brad Jr. Junior. We'll just go with Junior. I like Junior.
There you go.
All right. I mean, here's somebody. Look at this. I mean, these are the questions these are the comments rather that people make that when I'm talking to people that have owned houses a long time. I bought my house in 1999 at 9.5%. I was scared, but looking back, I should have bought a bigger house. I can't tell you how many times I sit down with somebody that's owned their home for an extended period of time. There's two things they always say. One is, I bought my house. I had no idea how I was going to make the payment because it was so expensive back when I bought it. To them, it was expensive. And secondly, I should have bought either more house or more houses based on what I know now, right? We talked about, that hindsight trigger, or hindsight rather, it triggers those thoughts that, hey, if I would have known this, then I would have done this. It's similar to people that are in the market now thinking, I wish prices were back at 2019. They're not going to be back at 2019. What's going to happen is in 2 years, you're going to say, God, I wish prices were back to 2024. Or, we could keep going, but that's where we'll leave it.
Jeb, we're gonna jump ahead because this is one of my favorite silly things that people love to say. The S&P 500 has had an average annualized return of around 10% over very long periods. It's actually closer to 8%, while average annual real estate returns are more in the 4 to 8%, probably closer to 4 over the longer haul. So anyway you cut it, let's call it 4 and 8. It's half. So I should invest in the S&P, right? No, because today you have about $8, and $8 compounding at 8% grows very, very slowly, even with nice large monthly contributions. Your house, you're going to borrow thousands and thousands of dollars.
Leverage.
You get all of the appreciation at 4%. And at the same time, I don't have to own stocks. Stocks don't do anything for me in my life other than grow and accumulate so that I can spend them at a later date. I do need a roof over my head. So I don't want to live with family. If I don't want to live on the street, I have the alternative of paying rent or owning. So I have a forced savings plan. I have leveraged depreciation, and I have a roof over my head that I have control and pride of ownership. So this isn't saying, hey, don't invest. Everyone should do all of the above: earn, save, invest, including invest in a house and in your 401k, and hopefully you have some extra and you're putting it into index funds, buying the S&P. So it's anyone that goes, get some more. Well, cool. We've shown the numbers. 40 times greater net worth for homeowners than non-homeowners.
In fact, we did an entire episode
net worth
on it.
Is in home equity. A whole
we
episode.
did an entire episode on if you decide not to buy a house, what you have to do in order to come out with the same essentially return at the end of the day as somebody that bought a house. I don't know what episode it is. You can go back and listen to it. It's in season 2. But it's homeownership is part of the puzzle. It's not the entire puzzle. Homeownership itself is not going to allow you to retire in most cases.
You can't, it's not spendable money. You need a reverse
Yep.
mortgage or to sell and move to another area. That's why you need to do both. Because most people go, I like my house. I've lived here for 50 years. I don't want to move. And reverse mortgages suck. I want to leave my equity to my kids. That's how most people think. And so you have to have both, right? And it's just, and I hear people say, oh, wow, you guys are acting like home prices only go up. Nope, they go down. Guess what? The S&P does also. If you invested in the 70s, you're like, stocks suck. So neither of them are guaranteed to do anything over the next 2 years, 5 years, 10 years. They're both likely to perform well over the next 30, 40 years, but in any short time frame, it can be less. And I will say, I don't think in the next 40 years, home prices will appreciate at 4.5% or whatever it's been for the last 40 years. I could be wrong. I've been wrong for the last couple of years, thinking the depreciation has lasted longer than it has, but I think we will see less appreciation in homes. And it still is an essential part of financial freedom and getting to retirement age where I only have to pay my property taxes or homeowner's insurance. And Jeb, it's funny, I had a conversation on the Vetted VA Live last night. It was a realtor and a lender in Texas. I found out all sorts of things about Texas. They have a scenario there, Jeb, where if you can't afford your taxes, it's basically like a reverse mortgage for your property taxes. They just keep accruing a bill. And once you kick, they come back and they take a bunch of your equity to pay the back property taxes. So it's not as simple as things have been made out to be. And it's not this either or, it's do all of the above. And in any short time frame, one or the other or both could have a bad result for you.
All right. We got 007 in the chat here. Says, can you please share knowledge on Irvine real estate with respect to Great Park? There's so much new construction there. Is that keeping Irvine prices from going up? No, not at all. I mean, look at what new construction is happening there. Do you see prices going down at all? Irvine is a very desirable city for many reasons. They're building a new Hogue facility there. In fact, I mean, they just built one, but they're continuing to add on to that. So you've got basically world-class healthcare. I mean, with UCI being right there. So you got great colleges, really good healthcare. You're not far from the beach. It was a master planned community in every sense of the word. Everything there has been thought out thoroughly. And when that plan is done, it's done. There is no more building. There is no more new community. But at the moment, it's not done. And there's a lot of people that want to be there. It was one of the safest cities in America for a long period of time. It's not for me, but a lot of people love it, and I see why. I see the advantages of wanting to be there. All of those things will keep prices going up. It's one of the newer communities in Orange County. All of those things are positive things for it. And you have the Great Park. The Great Park is depending on how you look at it, is an opportunity for Irvine to add a lot of cool things to the city. With that comes cost and other things that they have to figure out. But it's great. It's great for kids' sports. It's great for, concert venues, water parks, all of that stuff that's going in.
They got rid of their concert venue, Jeb.
I know, but now they're trying to figure out the permanent one. So it's still up in the air. I think it's being voted on.
The people that we had, so just so you know, we had an awesome temporary amphitheater, and it sounds like you're joking, right? It was temporary, but it was awesome and a great location, and they're building all around it. So the geniuses that bought homes right next to the amphitheater said, hey, we don't want that amphitheater anymore. There's noise. I bought next to it, but I don't want it here anymore.
That's how it works, Josh. That's how it works. Let's see here. Another question asking about real estate. Have you ever had a client get their earnest money deposit back from a builder? If so, what was the reason? So if I'm being completely transparent, don't do a lot of new construction. I think in my entire career, 20 years, I've probably done 10 homes that were new construction. So they don't come across my desk very often because we don't have a lot of it where I'm located. But with that said, builders, it's going to be hard to get your money back from a builder just in general, based on the way the contract is written. It really has to be something that the builder cannot perform their piece of the contract. Like basically there's not a house for you to buy in order for you to get your deposit back, because that contract is written to protect them. And typically they're not in the business of giving money back, but that's just what I know about builders. So the easy answer to your question is no, I haven't had that happen. Willing says, can you quit claim a deed to a property if there's a mortgage on the property? And the easy answer is yes, absolutely. You can quit claim a deed anytime. You can take yourself completely off title and still be
You
on the
can do
mortgage.
lots of things, but there
It's
will be
not smart,
repercussions.
but you can do it. So yes, you can. Josh, we got a couple more
Jeb,
questions
this
here.
let's
Something
let's
you see?
close the loop on that for
Yep.
anyone watching. You can do it, but it also can trigger a due on sale clause. The lender has the option, if I own a house and I quit claim it to Jeb and it has a mortgage on it, that lender can go, hey, you sold the house, you no longer own it. We're calling the loan due. And Jeb now has a home and he has the loan that has to be refinanced, or he's in default. I'm technically in default, but he's the new owner and can get foreclosed on. So you have to be careful with the fun stuff that you get ideas of doing. Very, very rare. Lenders rarely call a due on sale clause if that mortgage is continuing to be paid on time, but it can and does happen.
All right, good stuff. Pablo just closed on a home in Murrieta, 12-day escrow, 20% down, 6.5%. Happy buyer. Congratulations, Pablo. Hopefully, we provided a little value to you during the process and little insight. You didn't call me to help you buy your house, so you
I
clearly had
didn't
a
do
real
the
estate
loan.
agent, so I didn't help you on that piece, but hopefully we gave you something that you could use to make better decisions during the process. With that, Josh, I want to mention, been on an hour at the moment. If you found any value tonight, do us a favor, hit the thumbs ups. Consider subscribing to the channel to support the work we do here. It does actually mean something. It's something that we follow because, for one, it helps that algorithm push it out to more people like you and helps us educate more home buyers. And on top of that, Josh, if you're looking to work with a professional, not some person that just got their license that has no idea what they're doing, make sure you use that referral link below and contact us. We want to help. We want to guide you through the process. We are here providing education with the intent of giving you the information you need, but we're also here to help you follow through and actually accomplish that goal. So if you need us, want us to help, you want a professional on your side, use that referral link. So Josh, we're been on an hour. Are there any questions that you feel inclined to answer before we leave?
I want to fact check myself here because while you were talking, I started Googling and I underestimated the power of the bull market the last 2 or 3 years. AS is actually correct. The longer term average on the S&P, whether you pick a 30, 40, 50-year time horizon, is about 10%, slightly over 10%. Everything else I said, I still stick to. Homes have been about 4.5%. S&P over double that. And everything that we said is still true. Please do both.
All right. Good stuff. Ray of Sunshine just said he appreciates us. Didn't use us, but appreciates us. That's all good. Carlos, how about a HELOC and assume mortgages or the new winning cash? Blah, blah, blah. So is there another part to that question, Josh?
It's almost more of a statement, but
Yeah.
we've seen HELOC interest pick up here. And I think we're kind of also getting to where you're having sales unlocked, people who thought they could wait out until rates were back at 5%, just saying, screw it, I got to sell my house, and they list. Other people saying, hey, I'm not going to take cash out of my house until rates get better, just saying, whatever, I'm going to do it because I need to pay for my kid to go to college. I need to put a pool in. I need to consolidate debt, whatever it may be. So we are seeing it pick up. I'm seeing more interest, more people reaching out. But yeah, that's what we're looking at.
All right. And one more. Will dual agents be more favorable considering the new changes in buying? Favorable, I'm not sure is the right use of the word. Will it happen more in states that allow it? Potentially, but you also have to understand with that dual agency, you're not getting represented as a buyer in most cases. And most dual agents aren't going to work for free. So there's still going to be a fee that needs to be paid in order for that agent to represent you. So that's something you have to consider. Nobody's going to do anything for free. But more people are going to try to go to the listing agent, I would assume. It's happened even in the market that we're in now because inventory is tough. So you got people, in order to be more favorable, going to the agent in order to get their offer accepted. In fact, I've had people recently come to me to represent them, and their offer still didn't get accepted because they weren't willing to play ball at the prices they needed to play ball in order to actually get their offer accepted. So it's not just going to the agent, it's also taking the agent's guidance and doing what they're recommending you do in order to be in the best position possible. But what I truly think is that dual agency is probably in the early stages of going away entirely. California still allows it. A lot of states still allow it. It is definitely an ethical concern. And there are pushes out there to get rid of it. I do believe it will take place at some point. I just don't know when. So that's just my thought, my guess. And I'd be okay. I'd be okay with that. I'm not a person that says, hey, you got to have dual agency. I think that there's a line in the sand there that doesn't need to be crossed, and it often is in many cases. So, Josh, hour and 3 minutes. I appreciate you showing up every week and being a part of the show. Thank you. Thank you, Josh. Thank you.
I look forward to chatting. Wednesdays, Jeb and I get to talk through these screens to each other for almost 2 hours. So it's good times.
Yeah, because we filmed the podcast today and we come back and we do this episode. Marcus says, can you make the live stream 2 hours? No. I can't, honestly, because of my schedule with kids' sports and everything else. It's very difficult to be here for 2 hours. But I would be willing to entertain another day of doing a live stream on the Educated Homebuyer channel. If Josh was down for it, we would just have to pick a time. It couldn't be at night. It would have to be another time, but you could always go back and watch it. So Josh and I can talk about that at another time and see if that's something, but I would consider doing it. It would just have to be a little bit different. Not all in one setting. So anyway, appreciate you guys. Appreciate the support. We will be back next Wednesday for another week of the Educated Homebuyer Live. Until then, adios.
Amigos.